All right, welcome to your real estate podcast. My name is Raymond Raffle, and we have a very powerful episode for you guys today. Today, we're going to focus primarily on the buyers. We're going to talk about signs you're ready to buy a home. How much house can you afford? How much money do you need to buy a house? How to buy a house with little money down. Biggest red flags when touring a property. What makes a good investment property? And to wrap it up, what I wish I knew before buying my first home. All right, so without further ado, let's get started. But I'll say this, if you haven't subscribed to the channel, please make sure you do so. That's how you help the channel grow. And also, if you're looking to purchase or sell a property in DC or Maryland, I'm your guy. My contact information will be in the description down below. So signs you're ready to buy a house. 1, your finances are solid, not just okay. A steady income that's likely to continue. So that's why even lenders look for at least 2 years of that particular employment. Not that you've been employed for 50 years. They want to know that you've been working for that particular company for 2 years. A down payment, often 3 to 20% depending on the loan type. Closing costs, typically 2 to 5% of the purchased property. That's average closing cost. I would say around the 4 to 5-ish, but 2 to 5 depending on what you can negotiate. Emergency savings left over after buying a house. This is huge. Don't drain everything. What I always recommend is have at least $5,000 after, depending on the house actually. But on average, at least 5 to 10 grand after you purchase the house, you should have in liquid cash, because you never know. Even if you may go through all these inspections and everything, things break. And you may want to have that just in case. Or just family emergencies. You don't want to spend everything and then you get an emergency and you're stuck. Your debt is under control. Lenders look very closely at your debt to income ratio. A good sign is your credit card and personal debt are manageable. Your monthly debt don't overwhelm your income. And you're not relying on new debt to make it work. So you don't want to rely on burning your credit card to pay the light bill, to buy gas, to buy food. So that is key. Your credit score is in a healthy range. You don't need a perfect credit score, but generally you want it to be 620 plus. The higher your credit score is, the lower interest rate they're going to charge you. So 700 plus gives you better rates and options. I would say once you hit 750 or 780, that's you get the best possible. So just try to get your credit score as high as possible. You can afford the full monthly cost, not just the mortgage. So a lot of people underestimate this. You're ready if you can handle, the mortgage plus principal, property taxes, HOA fees, homeowners insurance, maintenance, repairs. This is the surprise cost. I closed the house with a buyer in the wintertime, and the first bill she got was like $300 or $500 in electric bill. Just trying to keep the house warm. And she was like, whoa, I guess this is the cost of buying a house. So some unexpected expense she had to incur right there. So you're staying put for a while. Buying a house usually makes sense if you plan to stay in the area for 3 to 5 years. Your job and life situation are relatively stable. You're not expecting a major move soon. Next, you say you're emotionally ready for maintenance and responsibilities. You're ready if you're okay with repairs coming out of your pocket, because you can't call the maintenance guy anymore. That's a big difference with renting and owning. You can't call the landlord. You are the landlord, right? Yard work, HVAC issues, roof problems, etc. Next, you say you have a clear budget and pre-approval. A strong sign of readiness is your price range based on real numbers, not just guessing. You're pre-approved, your activities are getting there, and you understand monthly payment limits, not just the price of the home, Finally, we'll say renting is no longer serving your goals. For example, rent is rising faster than your income. So now you're paying somebody else's mortgage, or you're making somebody else wealthy. So you might as well start building equity. You want stability or equity building. So stability is like you probably are going to get married, or you landed a job where you think you're going to build a career, or you move to the perfect state or neighborhood and you want to build a family there, or just want to stay there, or you want to build equity rather than paying somebody else's mortgage off. You want to start paying yours off and building equity. And you need more space or control over your home. So space is a key thing, and control, just those are some of the rights that come with owning a house, right? The right of control, the right of exclusion, meaning you can exclude people from coming to your house, things of that nature, but you just want that control, right? How much house can you afford today, right? The honest answer is it depends on your income, debt, down payment, credit score, and interest rates. Most lenders still use the 28-36 rule as a starting point. Housing costs should stay below 28% of your gross income, and all debt combined below 36% of your income. So they do that and see where you are. Quick 2026 affordability estimates. You'll say good credit score, and you'll say 20% down. That's the max. I wouldn't say the max, but at least for conventional. Typically, mortgage rates are around the mid 6% right now. So minimal other debts, right? So let's say your annual household income, these are just approximates. It's not etched in stone. But if your annual household income is about $50,000, you probably can afford between $160,000 to $220,000 of a house. Once again, this is all predicated on other expenses and also where you live, and your debts, right? Minimal, you say your annual household income around $75,000, you're now looking at $250,000 to the $320,000 range. If your annual household income is $100,000, you're looking at $340,000 to $400,000. Once again, this all depends on your lifestyle. If you have a $1,000 or $1,500 car note, then you got to drop that house affordability, right? But let's say all things being equal, you don't have a lot of debt. These are the approximate home prices. If you're making about $125,000, you can afford between $430,000 to $500,000, right? If you're making $150K, you're looking at $525,000 to approximately $600,000. And if you're making $200,000, you're looking at $700,000 plus. So if your household income is $100,000 a year, a comfortable monthly payment is roughly $2,300 a month, which generally supports your home price around $340,000 or $400,000, depending on your taxes, your insurance, your down payment, right? Because the more you put down, the less you got to pay monthly. Don't forget cost of, property taxes. We talked about those. Homeowners insurance, HOA fees, maintenance, repairs, and then utility bills, right? Because these are all other costs you're going to add with that. So hopefully that gives you an idea of what you can afford in this market right now, right? Things change if interest rates go down or they go up. How much house do you really need? How much money do you really need to buy a house? Common misconception is that you need 20% down to buy a house. In reality, many buyers purchase homes with much less. I see that a lot now. There's this conventional 3%. Conventional 3% because back in the day when the 20% standard was set, homes were affordable. Even if they were not super affordable, at least the cost of living was lower. So if you make $60,000, $70K, $100,000, you can really afford something nice back in the day. Somebody once came and said, 140,000 is just breaking even in the poverty line, just the way things are expensive. So now a lot of lenders knowing 20% of a $400,000 house, that's a lot of money, right? When you think about that, it's like $80,000. Lenders know people don't necessarily save up to 80 grand to buy a house. So they made this conventional 3% where it's $12,000 more feasible, right? So we stick with that number, $400,000. 3% down would be 12,000. 5% down would be 20,000, and 20% down would be $80,000. Closing costs, as mentioned, would be usually between 2 to 5% of the purchase price. These can include lender fees, title fees, appraisals, taxes, and insurance. For a $400,000 home, expect roughly to have $8,000 to $20,000 extra, in closing costs. This is separate from your down payment. So you got to add that 8 to 20 grand plus that down payment, right? So next thing we're going to talk about is moving and initial home expenses, moving costs. Do you need to rent a truck, hire people to help you move, or do you have your buddies that are going to help you do that? Utility deposits, minor repairs, furniture and appliances. Are you buying a home with all new appliances, or would you have to replace some of those? Would you need a furnace? What I see sometimes, people buy these big mansions and they just move in what they have, and as they live in there, they slowly furnish the different rooms. I saw that with multiple people I knew. One person purchased a house for about 700 grand, brand new construction. By the time it got done building, it was worth 100 grand. So they bought the house, moved in with 300K in equity already. They didn't have enough money to furnish the entire house. They came from a townhouse to their forever home. So they just moved their townhouse furniture in certain places, and then as time progressed, they just furnished the rest of the house. And I saw that with another family I knew, pretty well to do. They bought $1 million home, but once again, they had a townhome. They just moved that furniture there, and a couple of years later, when I went to go see them, the whole house was furnished. It took time, right? So that can be a strategy. Real world example, for instance, for a $400,000 house, you put 3% down, that's $12,000. Closing cost is about $10,000. Move-in / setup cost would be another 3 grand. So total needed would be approximately 25 to 30 grand. Once again, these are rough estimates. I can tell you when I purchased my house, I needed a little less than that, but mine, so that was also in the pandemic time when interest rates were super good, right? So many first-time home buyers qualify for down payment assistance programs that can significantly reduce the cash you need to close. And in this market now, it's leaning more towards the buyers. So if you see a house that's been on the market for a while and the seller's motivated, and you don't want to, give them a low ball offer, where you can have some leverage is give them asking price, a little below it, and then also ask for some seller's help. That can help you. How can you buy a house with little money down? That was one way. I just mentioned that. But buying a house with very little money down is possible, especially for first-time buyers. Here are some of the most common options. One, FHA, which is 3.5 down payment. Minimum down payment 3.5. Credit score typically 580 plus. That's what FHA requires. Most lenders won't really work with you at 580. It's considered high risk. They would legally, that's the number, but lenders would like to see 600, 640-ish will be good. Allow gift funds from family members and friends. So gift funds is like your mother can give you 10 grand. Let's say the lender looks in your account, this money wasn't there. Closing time comes, you get $10,000 in your account. They want to know where that money comes from. They want to know you're not engaged in any illicit activities. So, somebody can write a letter saying they give you that as a gift. Popular with first-time home buyers on a $350,000 home, for example. 3.5 down will be $12,250. Conventional loan, 3% down. Programs such as Fannie Mae Home Ready and Freddie Mac's Home Possible, these are all things that can help you. Minimum down payment is 3%, often requires stronger credit than FHA. Lower mortgage insurance costs for some buyers. The USDA is a 0% down, and USDA loan, most people think you need to be in a rural area. Not really. So check with your local maps. There are websites where you can go to see if the neighborhood you desire qualifies for a USDA loan. Zero down, designed for eligible rural and suburban areas. No down payment required. Income limits apply. Many areas outside major cities qualify. So no down payment required, and designated, designed for eligible rural and suburban areas. So that's what I was mentioning. Not every big city you think of is excluded. Really look at the map and you'll see where USDA loans apply. VA loans, you're talking about zero down, available to eligible veterans, active duty military, and certain surviving spouses. The benefits of the VA loan: no down payment, no monthly mortgage insurance, competitive interest rates. So FHA loans are insured loans. USDA loans are guaranteed loans, right? So that's a little difference there. Down payment assistance programs can help you. Many buyers combine a low down payment loan with assistance programs that help cover down payment costs, closing costs, sometimes both. How much money do you really need? Let's say, for example, $400,000 home. If you're doing a VA loan, zero down, you only need closing costs. USDA loan, zero down, closing costs only. Conventional, 3%, you need $12,000 down plus closing costs. FHA loans, you're looking at $14,000 down plus closing costs, right? You can often reduce your cash requirement by, as we talked about earlier, negotiating seller paid closing costs. So talk to the seller, see if they want to help you out with some closing costs. You can write that up in your offer. Using lender credits, applying for down payment assistance, using gifts, funds from family. So another strategy, sometimes when you tour the property, if you see some repairs that the lender can let slide, you can still use that as a negotiating point to get some money from the seller towards closing. First time buyers, we can say, negotiate with the sellers, as I mentioned. And next, we're just going to go to the next topic here. Red flags when touring a property. I would say when touring a home, some issues are cosmetic and easy to fix, right? Others can be very expensive problems. So here are some of the biggest red flags to watch out for. You want to look out for large cracks in the walls, ceilings, or foundation. This tells you that's going to be a big problem. When you see a house, there are cracks on the foundation, the ceiling, because the ceiling kind of cracks because the house is linen. When the house, especially new constructions, when the house settles, you can see it shifts. Uneven or sloping floors, once again, that goes to the foundation. Doors and windows that stick or won't close properly, once again, that's a foundational issue. Once the doors, you see the doors are not opening or they stick, they're hard to close, especially ones that open this way, windows, not necessarily sliding down, but even the ones that slide down, if they're kind of crunching in, now the windows can't slide down, right? Stair steps, cracks in brick exteriors. So foundation repairs can cost thousands to tens of thousands of dollars. So that's why these signs are things you want to look out for. Cracks in the walls, ceiling, uneven and sloping floors, doors and windows that stick or won't close properly, right? Next, you want to look out for is water damage and moisture issues. Look for water stains on ceilings and floors, musty odors, because people can paint stuff, but sometimes the smell is still there. Mold or mildew, fresh paint in only one small area, maybe covering the damage, right? So damaged basement or crawl spaces. This matters because water damage often leads to mold, structural issues, and costly repairs. Another thing you want to look out for are roof problems, missing or curling shingles, sagging roof lines, water stains in the attic, signs of recent patchwork. So when you look at the shingles and you see one side is darker than the other, and that raises an eyebrow. A new roof can easily cost you 10 to 30,000 depending on the size, right? Electrical issues. You want to look out for flickering lights. When you want to cut on a light, it's flickering. Outdated electrical panels, extension cords everywhere, two-prong outlets. So I have some of those issues in some areas of my house where there are a lot of two-prong outlets and not three. Burn marks around outlets. Electrical upgrades can be expensive and may present safety hazards. Plumbing problems, right? You want to look out for low water pressure, slow drains, water stains on the sinks, signs of leaks around toilets, corrosion on pipes. Hidden plumbing problems can lead to significant water damage. So especially on the ground floor, the basement floor, underneath the kitchen, if it's a 2-level house, go underneath that kitchen level, see how that roof looks like, the ceiling, right? Or bathrooms, underneath the bathrooms, see if the paint was there, if they had to work on that. HVAC near end of life, so look out for very old furnace or AC units, rust or corrosion, loud noise during operation, lack of maintenance records. So you'll see a sticker on most HVAC units and they'll tell you when they were serviced. So replacing heating and cooling system can cost thousands of dollars. So that's another thing you want to look out for. Next is evidence of poor maintenance, just peeling paint, rotten wood, broken fixtures, neglected landscape, multiple small unfinished repairs. If visible items were ignored, there may be larger hidden issues. So they say where there's smoke, there's fire. So if you just keep seeing little things, you need to worry about that. So termite tubes, wood damage, rodent droppings, pest traps throughout the home. Pest damage can be expensive and sometimes very extensive as well, because you can see one thing, but then there's a lot more going on. Next thing you want to look for when touring a property, I would say, is neighborhood red flags, excessive vacant homes. So if you see a lot of vacant homes, you got to be cautious, because you're going to think, is this property going to be able to hold value, right? Heavy noise from traffic. If you're close to the highway, you got to worry about that. Let's say also railroads close by, poorly maintained neighborhood properties. Those are going to bring the value of your property down. And long commute times during rush hour. These are things to think about. You can fix a house, but you can't fix the location. Just keep that in mind. One more thing is price seems to be too good to be true. So if it's priced too good to be true, that you need to do some research about that. If a home is priced significantly below comparable properties, ask why hasn't it sold, Are there structural issues? Is there a location problem? Are there major repairs needed? The market often discovers problems before buyers do. So those are just things to think about. Just a quick summary, quick rules for buyers. 3 most expensive categories. You're talking about foundation, roof, and water damage, right? Next, we're going to talk about what makes a good investment property. So let's say you already have your primary residence, or you want to do some house hacking to get a second property where you can, let's say a duplex, multi-unit property, things of that nature, just to grow your portfolio. A good investment property is one that is reliable. What we're talking about is it regularly produces strong returns relative to its risk. The best properties usually combine cash flow, appreciation potential, and manageable expenses. So here are some main things experienced investors look for, right? A strong location. So location. Usually the biggest factor, Good signs, population growth, good jobs as far as job growth, good schools, low crime, access to transit, shopping, and employers, right? New infrastructure and development nearby. So examples of markets investors often watch include growing cities like Austin, Nashville, or suitable metro areas with diversified economies. You don't want an economy that's just hinged on one, let's say a plant, a factory. So like when you consider Detroit and what happened there, once the automotive industry died down, everything just kind of collapsed all the way around, right? Positive cash flow. The property should ideally generate more monthly income than expenses. Basic formula for cash flow, you want to do cash flow equals rental income minus, parentheses, you're talking about mortgage plus taxes plus insurance plus maintenance plus vacancy plus management, right? So when you do all those expenses minus your rental income, that equals your cash flow. So you want positive cash flow, which gives you stability during downturns and the ability to reinvest. Protection against unexpected repairs. That's what a positive cash flow does for you. Good cap rate. So the cap rate helps compare investment properties. So you do cap rate equals net operating income divided by the property value times 100%, right? General range, you're looking at 4 to 6%. Low risk divided by, just low risk. And then 6 to 10% strong cash flow. Very high cap rates can signify higher risk. Keep that in mind. Appreciation potential is another thing you want to look for a good investment property. Some properties don't cash flow heavily today, but grow significantly in value over time. So look for limited housing supply. So you want to check the inventory. Increasing rent, neighborhood revitalization, new employers entering the area. So like here in the DMV, they call Northern Virginia Data Alley, right? A lot of data centers are going there. Can be positive, a lot of jobs are coming, but how about the noise in the neighborhood? So you want to keep those things into consideration. Then the rent demand, property is only valuable if people want to rent it. Strong indicators are low vacancy rates, rising rents, nearby universities, hospital, or employment centers, right? Good amenities all around the area. Those are just strong indicators for good rent demand. Reasonable purchase price is another thing you want to look for great investment property. So great investment properties will signal buy at a discount whenever possible, right? Good investors will look at that, Just look for motivated sellers, foreclosures, cosmetic fixer-uppers where you don't have to pour a lot of money into it. You don't want a money pit. Under market rents that can be increased, So when you see the rents there are low, if you touch it up, you can get more money on that rent. Low maintenance risk. Older properties can look cheap but become expensive quickly. So watch for roof age, foundation issues, plumbing, electrical problems, HVAC condition. A property with fewer major repairs can outperform a cheaper one. Just think about that. Even though it's cheaper, if it has a lot of repairs that are going to be needed, it's probably best to get the more expensive property. Then you'll also want to look at financing that makes sense. Interest rates heavily affect returns. Many investors analyze the down payment size, the interest rate, loan terms, monthly debt service. For leverage returns, investors often estimate cash on cash return. Cash on cash return can be calculated by doing the annual pre-tax cash flow over cash invested, right? Multiplied by 100%. So that's the annual pre-tax cash flow divided by the cash invested times 100%. Then one other thing you want to check out for if you're looking for a good investment property is the exit flexibility. And good investment properties usually have multiple exit options, meaning long-term rental, short-term rentals, house hacking. You can flip it, you can refinance it, you can sell to owner occupants. Flexibility reduces risks, because if you got multiple ways to get out of that loan or your cash, if it's tied down, and you got multiple exit strategies for that property, that's a great sign. The last key point would be numbers that work conservatively. Experienced investors assume repairs will happen, vacancies will occur, taxes and insurance will rise. A deal that only works under perfect condition is usually risky. So the deal should work under varying conditions, right? If things go wrong, this deal still should make sense. So common beginner mistakes: they buy based on emotion, right? They underestimate maintenance, they ignore vacancy cost, overestimating rent, focusing only on appreciation, buying in unfamiliar markets without research. So the simple rule of thumb, I would say, looking for an investment property would be positive monthly cash flow, rent equals to like 1% of purchase price, which is harder in today's market, safe neighborhood, long-term demand, right? A very strong long-term demand. Example, if you purchase a property for $250,000, you want to target $2,500 on monthly rent. That's not a universal rule, but it's a quick screening tool, right? And then finally, we're going to talk about just things I wish I knew before buying my first home. So for instance, for me, I would have gotten more inspections done. I got the two basic inspections, like the structural and the wood destroying insect, but maybe I would have done a septic inspection, would have done a roof. Thankfully, none of those, like the roof hasn't caved in on me, no leaks or anything, but it's just something I would recommend. Also the HVAC unit, just more inspections. That's just my personal experience. Then generally, I would say most first-time home buyers don't realize how many hidden layers there are to home ownership until after they've signed. So also the windows, right? Windows, insulation, just things that are going to affect your monthly energy cost. They wish they knew before buying their first house. I'll also say closing costs, for instance. I was just told about 3.5% down payment. Thankfully, I had that extra 4 to 5% for closing costs, but literally I didn't factor that in when I went into looking for a house. It was when they brought the bill, I was like, wow, this is a lot. But then when you pay all of that, then you find out only a small fraction of that went towards your mortgage. It can be a gut punch, Right away, the monthly payment is only part of the real cost. Your mortgage might be predictable, but taxes, insurance, and maintenance aren't. Property taxes can change, insurance can jump after a year, and maintenance is constant. Roof issues, HVAC servicing, plumbing surprises, lawn care. A good rule of thumb is budgeting 1 to 3% of the home's value per year just for upkeep, right? A second surprise is how fast small repairs can add up. A leaky faucet become a plumbing visit. A minor roof fix can turn into thousands. A rental property, on the other hand, you don't have to worry about these things. You call someone in the house, But when you own the house, you're that someone. You're the one paying for them, right? So I'll also say, if you can get some home warranties, they have these like maintenance insurance things where you pay monthly. So if you got any major repairs that needs to get done, they can service it for you. Another thing people underestimate is how much cash you can still need after closing. Even if you escape, all the other down payments and you're able to scrape all that money, when you think about it, many buyers move into a house cash poor, house poor. They got the house, but now they don't have the cash without realizing it. So inspection results also matter more than emotions. Almost every house has issues. The key difference is whether they're cosmetic or structural. New buyers often fall in love with the property first and rationalize problems later. But the inspection is where reality shows up. I think I fell into that trap. I wanted the house, I liked the yard, and I saw certain red flags with the as-is sale, and I went ahead with the purchase. If I were to do it again, I probably would have gotten a brand new house or something close to it, where every year it seems like I'm doing a major repair, right? I knew what I was getting into, but I didn't really know what I was getting into, if that makes sense. So there are also lifestyle trade-offs. Owning a home ties you to a location and responsibility. Want to move cities or switch jobs quickly? That becomes harder when you're thinking about selling, timing, equity, and market conditions. Financing is another blind spot, right? Your approval amount is not the same as what you should spend. Lenders often approve more than is comfortable. The approved number assumes ideal conditions, not real life stresses, emergencies, or lifestyle costs. So that's self-explanatory. You got family emergencies, lifestyle costs. You need just a cushion. So one thing I would say I'm thankful for is I never wanted to keep up with the Joneses. Just on a personal level, I could have gotten way more of a house than I got, but I knew I wanted some cash just for business, savings, and things of that nature. So I got a house that I think my mortgage is very, very affordable. When I look at people who I help to rent properties, I'm just amazed that, wow, you paying that much? I'm paying $6, $7, $8, sometimes $900 less than you're paying, and I own a house and you're renting for the same amount of rooms, So if you're trying to keep up with the Joneses and you want to get this massive house, hey, eventually we all will get our forever home, right? It depends on your financial situation. But even then, to me personally, it doesn't make sense when you buy a house and you're spending all your money. It's like then you get a raise, you want to upgrade your living. Sometimes just let the money sit and incubate for a little bit, right? Don't just, let's say you get a new job and you go get a bigger house or a newer car. Sometimes you let the money sit, accumulate, then you make a move comfortably. Finally, appreciation is not guaranteed in the short term. People often expect home values to always go up, but real estate moves in cycles. If you need to sell within a few years, market timing can matter more than you expect, So thankfully, I haven't had to sell, but you're looking at Zillow. I look at the appreciation value. I thank God when I purchased my house years ago, it has appreciated in value. But what if that was not the case and I had to sell or I had to move? I know people who are going through foreclosure, close to foreclosure. Let's say they fell behind on their rent and they're trying to get out of the house, but they're not getting what they thought they would get, especially in this market. It's no longer a seller's market. So those are things you need to watch out for. Well, I hope you guys enjoy the video. Once again, if you like what you saw, or if you have any questions regarding buying or selling a house in DC or Maryland, my information will be in the contact down below. Make sure to like, comment, share, and subscribe. Thank you.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.